Welcome to Real Estate Investing for Women. On this show, you will learn how to create wealth through real estate the blissful way. That means with very little stress and very little time. We talk about strategies, mindset, heart set, money smarts, resources, and so much more to ensure you're able to create the success you most deeply desire. Now, here's your host, Monica Sawyer.
Today, I am so excited to welcome back to the show my friend Jen Du Plessis. Jen is known as America's Lifestyle Mastery Mentor. People most attracted to Jen are high-achieving professionals and entrepreneurs who are missing something. Through her mastermind, she helps people increase their awareness of what's possible to multiply the results in record time while having the courage to say yes to their personal lives. She is the CEO and founder of numerous companies. She is from Northern Virginia and attended Colorado State University, where she studied architectural design and construction engineering. She has been married to her high school sweetheart of 38 years, has 2 children and 3 grandchildren, and she has been in the financial services industry for 4 decades and was listed in the top 200 of nationally ranked mortgage originators and funded over $1 billion in mortgage loans. Wow. She is an 8-time #1 Amazon bestselling author, host of 2 top podcasts, and a TV show host. An expert in living a life of luxury, priority and time management, business relationships, business scaling, sales management, and a certified mastermind facilitator. Wow, that was a huge mouthful. She is a charismatic speaker, as you guys will see today, sharing stages with such icons as Tony Robbins, Les Brown, Darren Hardy, Jeff Hoffman, Sharon Lechter, and many more. She believes that entrepreneurs can live their legacy while building it, and it's time to start living a life of luxury every single day. Hello, Jen. Welcome back to the show.
It's so painful to listen to all that every time I get introduced, but it's what happens, right? You have to do it.
It's true. It's so funny, right? Because the ladies, we were in the green room chatting away, and I was like, "Okay, I've got your bio." And she's, "No, I've updated." And it's so funny because I just updated mine too, so I totally know that
we grow, right? That's what happens. Right. You have to add stuff, yeah.
And that's what we are doing. That's what we're supposed to do. We're supposed to grow. So I absolutely love that. Thank you. So Jen, the last time you came on the show, we talked about mortgages and some of that stuff. Today, I really want to talk about specifically the 30-year versus the 15-year. I get questions on this all the time about which one should I invest in because the rate is lower, or which one should I get, right? When I do my refinance or I do my purchase, because one has a lower rate, but the other one has a lower payment. And I know what I say, and my ladies know what I say, but I really want to have to hear what you have to say about that, because you've been in the industry about that, for a long time.
Yeah, well, thanks for the question. I mean, of course, when I was originating, I got asked that question all the time. And it was funny because I think that people don't believe that you can customize a 30 or a 15-year fixed rate loan. Mm-hmm. Or 20 or 25. I used to have clients call me and say, "What's your rate?" Which is the wrong question to ask, by the way. But what's your rate? And I would say, "Well, what have you been quoted on a 30-year?" And they would tell me, and then I'd say, "Well, did they tell you about the Super Saver 25?" And they're like, "No." Well, all that is a 25-year term. There's nothing really different, but you are customizing. And, even the difference between a 30 and a 25, if you look at how the loan pays off, you look on a graph, it'll pay off sooner. Not as much as a 15, right? There'll be a smaller line, but depending on what the person's life goals are, the goals that they have, that can be a really good strategy for you if you're going to be in the house for a shorter period of time, because at any point in time, you have a lesser balance, right? Mm-hmm. And if you want to accelerate that. So I think the answer to your question is, it depends. And and I used to buy depends. I used to buy Depends and just bring them and go, what do you think the answer is? And everybody goes, it depends, right? So there is no one strategy that's good. And I don't think anyone should put their mindset to, I only do 30-year, I only do 15, I only do, because your life events, the market, the opportunity costs are all going to play a role in the decision that you make on it. So that helped get us started on this, and then I'll go a little deeper.
Yeah. So, and the other question before we move deeper, because I do want to find about this customizing. I was a mortgage broker for years. I didn't know about that. So I'm kind of excited to hear more about that. But the question is, so you said, what is the rate? And you said, that's the wrong question to ask. So what's the right question to ask?
Yeah. It's interesting because rate, of course, is an important factor. And this gets down to the customization. And I'll take you back to the Great Recession that we had. In 2008, we had this Great Recession. And at that time, and what gave them the momentum for that was that we had all been waiting for some kind of market churn. And of course, at the turn of the century, we were all into the .coms. Remember, and I'm talking like it was like that, like, so the .coms and leveraging the .coms and stuff, because we wanted more return on our money. And we wanted better ways to invest. And then what ended up happening is, because of .com, there were more, our eyes were opened and aware of what was happening in generally in investing and in the marketplace. And as consumers, all of us, we were hating to open up our 401ks every month, every quarter. We're like, oh, it's going to be painful, right? And so we had this demand of saying, I want to do, and I don't want to go too detailed, but like into the tranches, of secondary market and everything, where loans are sold in pools, right? So think it's a swimming pool, and they're sold in pools. And on conventional loans, conforming conventional loans, whatever that may be in your area, just the standard cookie cutter conventional loan. If more people are buying that, the pool is larger. And so if you sell it once, it's like taking all your groceries in at one time. It's less energy, right? Versus 1, 1, 1, 1, 1. So if you have this big pool and you're selling the big pool on, if you called a lender and said, hey, I want a 30, a 45-day, 60-day lock, we're committing to delivering however many loans are in that pool by that date. Otherwise, there's penalties. So if there's one loan, it's going to be more expensive to deliver than if there are 1,000 loans in that. But the lender banks on the fact that they're going to have a plethora of loans in a smaller pool, a bigger pool, and therefore the cost of delivery is going to be lower. So what happened was back then, and you have to know this in order to understand, back then what happened was we said, well, if you've got this big pool of A paper and it looks pretty, you could drop a few little, so let's just call it clear water. You could drop just one drop of Coca-Cola.
Coca-Cola, Pepsi. Yes, Pepsi, you're right. Okay, no, I got that.
Coffee, I'll do it that way. You could drop one little drop of Coca-Cola in there, or coffee, and it wouldn't impact the whole thing. You could 3 or 4. And then we as consumers said, well, let's mix up our, investing and stuff like that, or mutual funds. Let's mix them up a little bit and let's drop even more of this color in. And what ended up happening is it turned color, right? And it all just got really bad, because now we had more non-performing and difficult loans into these pools, that we thought we would get the good returns. And of course, we were all living high on the hog, because we were like, look at this, look at this, look at this, as it came in. So what people have to understand is that the rate is very important. I get it. But at that time, what started happening is that, and I had been selling a negatively amortizing loan for way back in the 80s and 90s for 9 years. Best performing loan in the marketplace, lowest turnover, because no one would refinance because the rate was always better than the market. And best performing loan. But we got all these brokers who came in and said, well, I want that product too. I need to have a mix. And the start rate was 1.25%. And the lender just said it's 1.25%. They didn't tell you about all the implications that it's negatively amortizing.
That's right.
And so the best rate in the world could be financial disaster. So you don't want to shop for rate. You want to shop for the terms that fit your financial situation and your life events at that particular moment. So it isn't that there's a better question. It's that it's not the only question. And a lot of people lead with that. And yes, it's important, but honestly, every lender is within an eighth, a quarter, sometimes 3/8 to each other. There's more than 365 lenders in the world. You're never going to find the best rate every day.
Right.
Because it's all shifting around. If you call at noon and the market tanks and you call someone at 4, then they're going to have a higher rate than the one you talked to earlier. But when you call them back, they're going to have the higher rate. And vice versa. Right. So it's not about the rate. It's about who can deliver what your financial goals are, who can help you dissect the DNA. And this is why you want to customize it. And so when I say customizing a 30, 15, 20, 25-year loan, it's, do you want to put 5 down, 5%, 3%, 0, right? There are different rate options. There's 17 different things that can affect the interest rate. That's customization of interest rate. So when you call and go, what's your rate? My rate's anywhere from 2% to 8%. What's your deal? What are your terms? And as we talked on the last show, that I do a lot of situational lending. It's called non-conforming, right? I do a lot of situational lending. And people will say, well, yeah, but the rate's high. Well, and it's not that high anymore. There's not a big spread. But I go, yes, I understand that the rate is high. However, your situation isn't fitting into the conforming. You need to understand that. So it's not about the rate. It's about who can get you across the finish line with the best terms for your financial situation at that moment. Yes, right?
Right.
So I don't know if you have a question, but I can answer the difference between 30 and 15 and how my concept of that.
Yeah. So I do have a couple of questions. So the first thing is I want to do a little comment. So I was also in the mortgage industry when there was all the negams were the biggest thing. And there were a lot of people that got killed by the negam, or they thought they got killed by the negam, right? But the problem is that it was because they weren't educated. So I love what you were talking about, Jen, where you're like, well, you just need to understand the terms, that my rate was 1.25, but it was at that rate, it's negatively amortizing. Those negams all had a rate where you were not negatively amortizing.
Correct.
You actually pay that, right? There were 4 options.
Yeah.
And so when you're looking at that, like all of my clients that did the negam, equity was going crazy here in the Bay Area. So a negam actually made sense.
Right.
But then as the market turned, they started to pay, so that now they were just paying their minimum in order to not negam, so that they could wait for the properties to recover, because we also took a huge dive as far as equity, right? So instead of getting called on those loans, they adjusted their payment. What happened with a lot of people is they ended up getting called on those loans because they didn't understand that they could make a different payment.
Right. And and definitely that's a consumer issue, because we lack the fiscal education to understand how those work.
Right.
But I think it's more on the hands of the lender, because if the lender, like you go to Bob and wherever Bob works and Bob manages your assets, it's Bob's job to call you and say, that stock we were in, it's going down. And we all experience this. We don't get the call from Bob. We find out when we get our statement, well, why didn't you call me, Bob? Same thing happens with your CPA, right? They go, hey, you owe $30,000 in taxes. And you're like, how'd that happen?
Yeah.
Well, I could, if you had told me at month 6 to make some adjustments, I would have made adjustments. And I think this is a huge failure in the financial services industry, and it includes lenders. Anybody who, I don't care if you're in a 30-year fixed rate or if you're in a NAGAM loan, we need to be able to manage and help guide clients. And that's what I coach on for loan officers, right?
Yeah.
Is having that mortgages under management and not being, I used to say, if you've been orphaned by your last lender, I'd like to adopt your loan. Because they all left at the end of 2008. It's like dropping off like flies. And these people were crying. They had negative interest or negative equity, and not because of NAGAM loans, but because of other things. And they didn't know who to turn to. And I said, well, I'll adopt your mortgage. I'll be the Bob who helps you go through this. And we had emotional refinances on 30-year fixed rate loans, which is interesting because you had just said, that adjustment, because you could make the minimum payment, the interest only, the 30-year and the 15-year payment. And people just go for the low payment. It's just like your credit cards. Why do you go for the low payment? If you pay more, it'll pay off. If you don't, you're just meeting the interest. That's it. And not even all of it.
Not even all of it. Your
Not
credit
even all of
card, if you do the minimum payment, it's a neg am. You
Right,
end
it's
up
a
paying
neg am.
interest on the interest. Actually,
Yeah, it's the same exact thing. The only difference is it's not on an appreciating asset. So be thankful that you have that on your mortgage. But yeah, so it's, so sometimes we just did an emotional refinance on a 30-year fix, and because people would say, well, I'm not going to make any payments. I go, hold on. I had a guy call me once and he said, for the last 7 years, I've been making an extra $100 payment on my mortgage, not my client until I had this phone call. And he said, an extra $100 on my mortgage. And he said, all that adds up, $1,200 a year times 7 years. So wouldn't the lender give me that credit and allow me not to make the payment now since I lost my job?
No.
Oh, if you would put that $100 in the bank, you could draw from it and make your payment while you're looking for a job. Then you could refinance. But now you haven't made your payment and you don't have a job. I can't help you. Mm-hmm. Right. And these are the discussions. And it was so funny because we had Pepto-Bismol. I had a little bottle of pink Pepto-Bismol. I had a box of tissues and I had a bottle of wine. And I said, pick your poison because this is going to be a painful conversation. Yeah. But if I could do an emotional refinance to help them, strategize on how they're going to get out of it, if the market isn't going to give it to them, how they can get out of it, that's, huge. But on 30 and 15-year mortgages, it doesn't matter. The customization is, do you want to put 5 down? Do you want to put 20? Do you know when you put 20% down, your rate's higher than if you put 19.99% down?
I did not know that.
And people don't see it. They're, I'm going to put 20% down. I don't want that private mortgage insurance. That actually would give you a lower interest rate. So you have to ask these questions. You have to figure them out. As you know, one of my specialties was investors. And with investors, people would come to me and say, I want a 30-year fix because I want the lowest payment. Mm-hmm. Right? Because they want cash flow.
Mm-hmm. 15. Oh, yeah. Go ahead.
30-year. Because I want the cash flow.
That's right.
But the problem is, as investors, we're doing the same thing. When we make that transition from an owner-occupied homeowner to an investor, you have to take the emotion out of it. It's about the numbers. And so when we go to a 30-year fixed rate loan, while you may have the cash flow, you're also not paying down the balance on your loan. Right. And we're only looking at cash flow, and we're going to buy for cash flow or appreciation. Mm-hmm. So we're looking at cash flow. It amazed me. So I would tell people all the time, I'd run these numbers all the time. What if we did a 15-year on an investment? People, oh my God, my cash flow. So your negative cash flow, I remember running one of these, negative cash flow was like $275 a month. Mm-hmm. And he said, but that's not why I'm buying the property. And I said, but you're buying the property for appreciation. So we're going to go for negative cash flow. But amazing. I can't pay $275 negative cash flow on an appreciating asset that gives me a tax deduction, but I can pay $700 on a car.
Right.
And while you have a job, this is a strategy. If you didn't have a job, this is why I say it's all customized. If you didn't have a job and you were solely relying on that income, then of course we would put you in a 30-year so you have the cash flow. Mm-hmm. But while you have a job and you can afford $275 negative cash flow, let's accelerate the payoff and let's use these first 2 properties as jumping stones, whatever you want to call it, jumping things to your next property. So now in that same 5-year time frame that you would own the house, you could sell it. One, you'll sell it and have had cash flow. The other, you will sell it and be able to have, I already have 2 going. Sorry. You'll be able to sell it and have more equity to take those 2 properties and go buy, or that 1 property and go buy 2. Mm-hmm. And now we'll put you in the 30-year. So that's called step investing. And people just don't see that. And it's how Brian and I were able to, exponentially increase our portfolios, because we would take 1 and hold it and then sell it and buy 2. And then the next one, we would just buy normal. And the next one, we would buy 15-year term, hold it, sell it, buy 2 more.
Interesting.
And so that's why, for the investor side of things, there's a great difference between a 30 and a 15, or maybe a 20, whatever, is comfortable. But we just jump into these crazy, 30-year terms because we think it's a safety, but we're not going to have the loan that long anyway.
Mm-hmm. And that's true. We're not going to have the loan that long anyways. Most of us don't have, we
Never.
refinance anyways. So whatever.
That's an AGM loan, by the way. Every time you refinance, you rob yourself of equity because you roll the closing costs in.
That's exactly
That's an AGM loan. Every
day. That's exactly right. Yep.
So it's not about the rate. It's about the strategy you need to be looking for and how long you think you're going to have the house and the loan.
Mm-hmm. Okay. So what you guys do is you get a house, you take a 15-year loan, pay it
Back then.
down back then, you
Yeah.
sell it. And then with that equity now, or whatever you get from that, you use that and you buy two. The next
Yeah.
one you buy on a 15, and those two you finance on a 30 because you're going to hold them longer.
Yeah.
And then you buy
Then I
another
buy
one.
another on a 30. And then I buy another on. So the two houses that I bought,
Mm-hmm.
one will be on a 30 and one will be on a 15.
Oh, interesting. Okay.
That 15 I will sell in 5 years and buy two more. One will be on a 30, one will be on a 15.
Okay. So ladies, just to explain and jump in here, Jen, if you want to, just to explain what happens when you're amortizing loans on a 30-year, in the first 10 years, basically, you pay basically all interest. So you get this great write-off, but you're not paying down your principal at all, right?
It's actually you're 21 that
Okay.
that the streams cross.
That the streams cross. Yes, absolutely. But those first 10
21.
years are like all
Interest
interest.
only.
Yeah, it's
Glorified
basically
rental.
like exactly, right? But when you're in a 15-year, you're paying down more principal, which is why her equity is growing. You're paying it down. So your equity is growing because the property, the asset is appreciating. You're also paying down principal. When do those lines cross in a 15?
At year 9.
Year 9. Okay, so it's a lot sooner, right?
Mhm.
So that's why she's doing it that way. She's got one that she's holding, one that she's paying down so that she's building equity so that she can buy another
So I can
piece
use
of property.
that property to buy more property. Yeah.
That's
Instead
right.
of trying to save 20% down every single time for investors. Now, at the time, I was doing 10% down for investors because that's what you could do.
Mhm.
So that was to my benefit too. But again, this is why your lender is so important to you and why
Mhm.
what's your rate doesn't work.
Mhm. I
Does
love
not
that.
work. It's just whether it's owner occupied and investor, that doesn't work. You have to really talk about the strategy. I call it EHE strategy. What's your entrance, holding, and exit strategy
Mhm.
for everything? And we know as investors, we're always going to have an entrance, holding, and exit strategy, but we don't think about that on owner occupied. What is your entrance, holding, and exit strategy? And I think that's important, given what the long haul looks like. It's not just enough to find a good low rate. It just
Mhm.
isn't. Now, you and I had talked about too, is that, obviously the rate on a 15-year is lower than on a 30 because the investors they can't predict 30 years out. It might be a good loan. They don't want those low interest rate loans on their books, right?
Mhm.
Not especially now, even now with inflation, everybody who refied last year, they don't want those loans on their books. They want to get them out. Because, they're not making as much money as the inflation side. Now, of course, with new loans, they are, but you get a lower interest rate on a 15-year loan. And so more of your payment goes to principal than to interest on a 15-year loan. So it pays off more, and less of your payment goes to interest on a 30-year loan. But if you're going to commit to a 15-year loan, you're committing to that 15-year loan. And I know you and I talked about this in the green room. It's better sometimes to get a 30-year loan and pay it as a 15 anytime you want, because no loans have prepayment penalties. So you could pay it anytime you want, annually, monthly, it doesn't matter. Again, I would say put your money someplace else and make lump sum payments if that's what you want, because there's no obligation to pay it. Equity, what is your equity growing at? You can't cut a piece of your drywall and walk into the bank and say, hey, I'd like some more of my equity back. That doesn't happen. So I'd rather retain my equity in the form of cash in my pocket, right? In my bank account. But there are opportunity costs too. Yeah, you're paying more and you're accelerating the principal reduction for whatever reason you have. So I would challenge people, why do you want to own your house free and clear? Because you don't have any tax benefits. It's trapped in there. I'll tell you, even in my house right now, I have a little over $750,000 of equity sitting in my house, and it's killing me.
Right, because it's dead money. Basically,
it
you
is
can't
dead.
use
It's just sitting there, and I hate it. But because we were going to move, but my husband had a medical thing, and now we can't. We just got to sit here and bear it. But it just drives me crazy. There's no benefit whatsoever to having all of that equity in there. But yes, you could reduce the equity. The interest is lower. But if you took a 30-year fixed rate and the interest is higher, and you have a lesser payment, you could divert that money that you would have paid on the 15 to something else. You could divert it to paying off debt. You could, to non-preferred high interest rate debt that's not tax deductible. You could divert it to funding your child's student loans or education. You could do what you and I do, right? We get capital and then we seek around and try to find another place to invest our money. So that's opportunity cost. So if you get a 15-year loan because you want equity, you're missing out on opportunities to be able to create other cash flow, passive income.
That's right. Well, and think about the delta about that. So what right now is the rate of a 15-year?
Oh, I don't know what the rate of a 15 years because I'm not in the market anymore. I know fixed is 4. So I'd say it's probably, 3.25, something like that.
Okay. So 3.25 to 4. So your delta is
3/4.
3/4, right?
Mm-hmm.
3/4%. Okay.
Mm-hmm. Over 30 years.
Over 30 years. Okay. So you're paying 3/4% more. So you have cash available to you so you can make another investment. Do you think that you can
to get 30% return?
That's right. Even if you get 8% return, is it worth it to you to use that cash to make even 4%? I mean, nothing, whatever, like 4, 10, 5, 50, 30, whatever. It's more than 0.75%.
Right.
Is it worth it? And it gives you the flexibility. We just went through COVID, right? How many people were like, oh my gosh, I can't afford my mortgage. Yeah. Well, you have to pay. If you're at a 15-year and your payment is higher, you have to pay that higher rate, that higher payment. If you've got a lower payment because you've got a 30-year, you only pay that 30-year payment. So when times are flush, you're welcome to pay down that 30-year if you want to. Don't
or put it in the bank or invest it over. Yeah.
That's right. Right.
Right.
So that's why I usually recommend always get a 30-year because it gives you so much more cash flexibility. Yeah. Because I've seen 2001 came, 2008 came, 2019, 20, 21 came, right? We've suffered financially, and it's a bit of a security blanket, not for rate, but for payment.
Yes, it's always about the payment. Yeah. And, and again, what we were talking about in the green room is there's life events that happen to all of us. During COVID, people got divorced, people passed away, people got married, right? There are life events that depict whether you should be doing a 30, a 15, whether you should pay points or not, whether you should roll in your closing costs or not, whether you should escrow or not. All of those have to be looked at. Those 17 different factors have to be looked at every single time. And not because they need to be looked at to get you the lowest rate, but and of course you want the lowest rate. I get that. I want it too, right? But the lowest rate for your terms, for the things that you want. So, for example, people don't realize that, it costs extra money at closing to waive escrows, and people don't understand that. And the reason you don't understand that is because if you don't pay your taxes on your own, you don't pay them, they become first position and the lender could lose the entire principal. The entire principal balance of your mortgage if you don't pay your taxes, and it gets turned over to someone like me who buys tax liens.
That's right.
I'll buy a tax lien for $5,000 and I get a $400,000 house free and clear. Because the first mortgage is beneath that. And so it's a more of a risk on the lender side that you're going to be capable of striking that check in a timely fashion to not hurt their equity or their collateral.
Right. Yeah. So that's why they want to impound, right?
Yep. So that's why they want to do escrows and impound. So, all of this depicts, what your circumstances are. So just don't lead with rate. Get the whole gamut.
And go to somebody who understands. And this is why I talk about this all the time. When you're going to a lender, you want someone who actually understands investing, because the
Mhm.
conversation is different for investing than it is for primary residence. It's significantly different because the package is different. The goals are different. How long you're going to hold that loan is different. There's a lot of different things. Those are the basic things. Those are the things we don't even know to ask, or we do know to ask, but there's a lot that we don't know what to ask. And your
Right.
lender will help you through that.
Yeah. And I think even if it's owner occupied, you need to be taking this strategy and this outlook.
Absolutely.
You don't want order takers. You don't want to call Quicken Loans because they're not going to do anything, to help you. They're just order takers. They're there to give you the lowest rate. And if you go on Quicken or Rocket Pro, go on there and immediately they're like on you like white on rice.
Mhm.
Hey, do you want to talk? Hey, do you want to talk? And you see a great rate. And then if you scroll all the way down, you'll find out that you have to put 25% down and it costs 3 points to get it. And if you have a $100,000 loan, that's $3,000. If you have a $300,000 loan, that's $9,000 to buy that rate, which maybe your strategy, but most people don't have 25% down and 3 points on an owner occupied.
Oh God.
Right?
I can't even
Most people have
imagine.
5 or 10. Yeah.
Yeah. Could you tell me a little bit about doing a 20-year loan or a 25-year loan? I know that they're out there. I don't know how to get them. And I was a mortgage broker. So
Yeah. Well, all you have to do is ask. Yeah. All you have to do is ask because there's pricing available for 20 and 25 and 30-year loans. So 15 and below is going to be one price, same price. And anything above that is going to fit into the category of a 30-year fixed rate loan. And there might be a slight advantage. So it's a little yin and yang that goes on because like a 30-year with 20% down would be X price. A 25 would probably be the same price. But if you put another 5 down, you might get a better price. So and then it depends on the day, depends on the market. And so all of this adjusts literally moment by moment by moment all day long as stocks are trading. This is exactly what is happening with the market. So if you have a phone call with someone at 10 o'clock in the morning, that's yesterday's rates. If you have a call with someone at 11:30 or 12, that's today's rates as they were released. And then good luck the rest of the day because they could be adjusting all day long.
Got it.
Right. But this is why you're never going to find the best rate in the market. You're going to have to find what works for you.
Right. So if you, so we were talking about we sell the loans in buckets to Fannie and Freddie, whatever. Right.
Mm-hmm.
So when you're trying to get a specialized or customized loan at 25 or 20 years, doesn't that kind of take it out of the bucket?
No, it's still sold in the 30-year pool.
Got it. Okay.
Yeah, because it's still the same strategy. Yeah.
They just amortize it differently.
Yeah. What makes it really different is that it's the loan amounts, right? It's not the points you paid or the not points or whatever. It's the loan amounts. They're sold based on the loan amounts, which this is interesting because it's a question that I ask loan officers and realtors all the time, and you wouldn't believe how many can't answer the question. This is scary. So as consumers, you want to be able to answer it. Why is the interest rate higher on $1 million loan than it is on a $400,000 loan? So what do you think the answer is? We'll put you on the spot, not because you were a lender or anything, but just your natural question. I mean, because this is what consumers do. Risk.
It's just risk. Yep.
Yeah. And it's not. That is not the right answer. So for example, a $400,000 loan has someone who's putting 5% down, is squeaking by with credit, is squeaking by with qualifying ratios, is getting a gift, right? Probably has some job changing and hopping, is probably have a high debt. We're using all their money. Maybe they're even getting a 401k, right? Yep. Right. All of that. That's less risky than someone who puts down 35% on a $1.2 million home.
So I would just say that my husband and I have this conversation all the time. We can afford $1 million loan. Why are we getting hassled when someone who can't afford the $200,000 loan is not? So I totally get it.
The $2,000. Yeah. But the reason is the pool. There are fewer people buying that high of things. So the pool is always smaller, always smaller.
Okay.
And so the price across the sale of the pool is higher. It's not risk at all.
Interesting. Okay. So it's just the pool.
It's just the pool.
That's so fascinating. Thank you for that. I love that.
Yeah.
Now we know.
It's just the pool. That's why when you go to a bank and they have a portfolio loan, they have something that says, well, we can do it something unique and different as portfolio. It's higher price because it's not even sold in a pool. The risk is they're taking on the risk on its whole. They're shelving the loan and they're not selling it. So, and that's why when we get to situational lending, this non-QM, non-qualifying mortgage, non-standard Fannie, Freddie, FHA, VA, we start getting the non-QM, the rates are a little bit higher because you're asking them to take on, in this case, a more risky situation, a situation where they can't sell it in the secondary market, or now we can sell it in the secondary market. But again, the pools are smaller.
Mm-hmm.
The pools are smaller because less people are coming into that. And I call it situational lending, which is the name of my mortgage company, Situational Lending, because it's your situation depicts what the price is.
Got it. Oh my God, that was so good. Jen, I feel like I can talk to you about personal stuff all the time and mortgages all the time. This is so great. Thank you.
Thank you. Thank you.
Yeah. So Jen, tell everybody how they can reach you.
Yeah, the best way, you can go to jenduplessis.com. You can go, I think that's probably the best way. Just go to jenduplessis.com and send me a message or something, and I'll be happy to respond to you. That's the best way to do it. Also on the screen here, we have text, make your mark to 26786. You can get some preliminary information about what I'm doing too. I hold masterminds, very high-end masterminds that are for people who are, highly successful and are just missing something in their lives. And that's what I'm here to do, is guide you in that facet. I could guide you on mortgages. I could guide you on business. I don't coach anybody. It's just a mastermind.
Mm-hmm.
And we have some breakthroughs, some personal breakthroughs too. It includes a high-end retreat. So I believe that mindset plus mechanics creates momentum. You can't have one and create momentum. You have to have both.
Yes, absolutely. And so that's going to be, so ladies, you can text to 26786. So that's the number you're going to text to. It's 26786. And the thing you're going to text is make your mark. So you're going to text make your mark to the number 26786. And yes, it will go through, even though it's not a normal phone number. It's all set up that way. So that's perfect. Thank you. So Jen, before we move into extra, and ladies, so what are we going to be talking about in extra? We're going to be talking about priority management. This is one of the things that Jen does better than anybody else I know. She runs all these companies. She still has time to vacation, spend time with her husband and her grandkids and all the things that she loves to do. But she also runs all these businesses. So she does a really good job of priority management. So I wanted her to share some of her magic and wisdom around that. So we're going to do that in extra. So stay tuned for that. And Jen, before we move into extra, are you ready for our 3 rapid fire questions?
Sure.
Okay. Okay. Tell us one super tip on getting started investing in real estate.
Education. Get educated. Go talk to several lenders and find out who has what specialty where. Everybody has a niche and an expertise. Make sure that you go to the person who has it. Don't go to your buddy. Don't go to your grandma's sister's grandchild. Go and talk about what their expertise is in any type of investing.
I love that. And then what is one strategy on being a successful real estate investor?
my immediate response is education. I think that sometimes we assume things, right? We assume things, we get contracts in and we just go, yeah, I've seen that contract. Don't look deep into those. I would say that strategy is get yourself comfortable with looking at contracts and looking at terms, et cetera. And, ask some title companies around or escrow companies around you. If you could look at investor contracts, they can mark out all the people and all that good stuff, just so you get a feel of what it looks like, because that first one that comes in, it's scary.
Mm-hmm. Got it.
It's scary.
Yeah. and it is good. You feel so much more confident making offers and doing deals if you've got some depth of knowledge inside of you that you can kind of count on. It just gives you more confidence too. So,
yeah. Well, gosh, even with me when, in dealing with, our buyers club, the first time I got the contract in, I was like, ooh, this is foreign to me. I've got to really, I'm not going to make assumptions that they know what they're doing. So I'm going to challenge everything on there to make sure that I clearly understand.
Yep. Such good advice. And then what would you say is one daily practice that you do, Jen, that contributes to your personal success?
To my personal success. I'm going to be talking about that in the extra too, a little bit about priority management. It's just, for lack of a better word, get your head on straight, get a checkup from the neck up every morning.
Okay.
And meditation, prayer, all those good habits that you have in the morning too. Every day is a choice. You can choose to be successful. You can choose to let the day slip by. And I choose to be successful. And the only way to do that is to reformat myself every day, recalibrate every single day.
I love that. This has been phenomenal. Thank you so much for everything you've offered on this portion of the show, Jen.
You're welcome. Thank you so much. I sure appreciate it. I always love talking to you, Monica.
Yeah, me too. Yay. And ladies, thank you for joining Jen and I for this portion of the show. We do have more, so stay tuned for extra. We're going to be talking about priority management. If you would like to subscribe to Extra, go to realestateinvestingforwomenextra.com. You can subscribe there. The first 7 days are for free. Just go check it out at realestateinvestingforwomenextra.com. For those of you that are leaving Jen and I now, thank you so much for joining us. I appreciate you. Look forward to seeing you next time. And until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart deeply desires. I'll see you soon. Bye.
I hope you enjoyed today's show. If you'd like to find out more about how to become a blissful millionaire, go to blissfulinvestor.com. See you next time.